Hi, my name's Mike Garino. I'm a CDFA and an accredited investment fiduciary. I'm a financial advisor and wealth planner in Denville, New Jersey. Today, we're going to talk about 3 potential ways to save money on your taxes this year. So let's get into it. A little bit about me. Like I said, my name's Mike Garino, and I'm the father of 3 boys, ages 21, 18, and 15. My very first job was that of a paperboy growing up here in Denville. Fast forward, after college, I spent 15 years climbing the corporate ladder. I realized after doing that, a goal in my life was to help other people. So I retired from my IT career in 2006, and 2 years later, I started my wealth management practice here, where I spend my time helping my corporate friends, many whom are executives and professionals, manage their investments and plan out their ideal retirements. So the reason I created this presentation really is because I know a lot of my friends are paying too much in taxes, or at least they feel like they're paying too much in taxes. And the reason they know this is when they sit down with their accountant gives them that look like, you're not going to like this. You're not going to like this at all. And they get that sinking feeling in their stomach like, oh my gosh, what could I have done better? Could I have stopped this problem or reduced this problem? The simple answer is maybe. So let's go into it and find out what my friends can do. And you can do as well. So the first tip I'm going to give you is called the catch-up contribution. And we're going to talk about what catch-up contributions are and the benefits of them. It's pretty interesting. So something magical happens the year that you turn 50 years old. The IRS allows you to make catch-up contributions in your retirement plan. A retirement plan could be a 401k at work, your IRA, a 403b, a 457, but a retirement plan that you have at work. And the catch-up contributions simply mean you can make larger qualified retirement contributions than you were previously allowed to do. So deferring money into your company retirement plan or your traditional IRA essentially takes money that you would have paid taxes on that current year and defers it for taxation later down the road, usually in retirement. Deferring income into retirement plans and traditional IRAs reduces take-home pay and reduces the taxable income. So let's look at an example. Here's Joe. Joe makes $100,000 a year, and he turned 50 this year. And he contributes $19,500 of his own money to his company's 401k plan. That's the maximum that they allow. But since Joe now turned 50, he can put an additional $6,500 of his own money into the 401k plan. That $6,500 extra is known as the catch-up contribution. That's what the IRS allows. They change these from year to year, so keep your eyes open for changes, but they usually only change them to make it a bigger contribution amount. I've never seen a reduction. So it's important to pay attention to your age and when catch-up contributions are available to you, and the amount of that catch-up contribution. So as a result, Joe is deferring a total now of $26,000, not the original $19,500. He's putting that in his 401k plan. So his adjusted gross income from $100,000 now goes down to $74,000, effectively reducing his taxable income by $26,000. Imagine what that would look like after 15 years when Joe is ready to retire. And again, this is a hypothetical example, but it gives you the gist basically of what a catch-up contribution is. And again, what's Joe doing here? He's getting an extra $6,500 off the tax radar screen that current year simply by taking advantage of the catch-up contribution. So let's turn the page a little bit. Now we're going to talk about tip number 2, taking advantage of HSAs and FSAs. Now, if you don't know what these are, they're health savings accounts or flexible spending accounts. The same kind of thing holds true here. When you reach a certain age, and in our example here, the age is 55, you're able to put more money into an HSA or an FSA. What does that mean? Well, let's think back to Joe. He was only able to do a maximum amount of $19,500 in his 401k, but a catch-up contribution allowed him to put more money into his 401k. The same thing holds true with an HSA or an FSA. when you turn 55 years old, now it's 55, not 50. Don't make that mistake. He's able to put more money in. So let's look at the numbers. It's right here in the chart. A single person can put in $1,400 of their own money into a health savings account, an HSA. A family can put in $28,000. Simple enough. The maximum out of pocket for a single person is $7,000, and the maximum out of pocket is $14,000 for a family. HSA contribution limits for a single person are $3,600, and a family is $7,200. But here's the catch, and the catch is a catch-up contribution. Catch-up contributions are available to people 55 and older and allow you to put an additional $1,000 into your health savings account or flexible spending account at work. It's great. It's just another way of taking $1,000 that would have been taxed and deferring it into your savings accounts, your health savings account or flexible spending account at work. With me so far? Let's take another look. We're going to look at tip number 3, pairing off losses and gains. Now, to be quite honest, this gets a little complicated, but I want to go into it with you because it's important. So let's look at the details. Case study. Janice has net long-term losses of $15,000 and a net short-term gain of $10,000. So she can take the $10,000 of losses and offset her gains. So it's real simple. I know it gets kind of complex and the charts we're looking at may make it a little, difficult to understand, but the gist is this. When you have long-term capital losses, you can use long-term capital gains to offset that. And the same is true for short-term. When you have short-term capital gains, you can offset them with short-term capital losses. This means that you just subtract the difference. You just do the math. If I have a gain of, $10,000 in one stock and I have a loss of, $10,000 in another stock, I can sell those both and pair that off and come out with a zero gain or loss. Now, there's an art and a science to this, and it's important that you understand it. But what I'm getting at is a lot of people overlook this step. A lot of people don't realize that they can pair off losses and gains or even have carry forward losses, which are something else that we're not going to talk about today. It's more of an accountant thing. But pairing off losses and gains is extremely important, especially in the case where you might own a lot of your company stock. I use this with my corporate professionals that I work with right now, and it works out well. And it's usually something that we do towards the end of the year because we kind of know what the gains and losses look like in a portfolio at that point in time. So again, like gains pair off with like losses, simple math, you do the subtraction, you either have a gain or a loss, but they offset each other to some degree, sometimes completely. So another tip, and this is a bonus tip, we went over 1, 2, and 3. The bonus tip I want to give you is a lot of my corporate clients are executives and upper level management. And the problem that they have is they have a giant chunk of their net worth, guess what, in the company stock that they work for. It's not uncommon. They've been incentivized to buy it, right? A lot of times there's an employee stock purchase plan. There could be, incentive shares. There could be restricted stock that they get as perks at work. And all this is the same stock that they own, right? They work for company ABC their whole life, and ABC has been rewarding them and making it easy for them to buy with, like I said, employee stock purchase plans. And these positions in these stocks get gigantic over time. One simple tip that I want to leave you with today is, remember, if your stock pays a dividend and you're reinvesting that dividend into the stock, you're making the problem worse if your intention is to diversify out of that stock or not contribute or not add to that large concentrated position. So one simple technique that I wanted to leave you with today is don't reinvest the dividend. It's really that simple, right? When you reinvest the dividend, you're actually taking the money that paid out as a dividend and going and buying more of that exact same stock. And this just makes the portfolio grow bigger and bigger and bigger. Let's look at the chart. This is a hypothetical example of, the S&P 500, let's just say, going back to 1970. And it shows you the difference of what dividend reinvestment has. That's the upper line here, right? This is with dividend reinvestment. And this is without dividend reinvestment. And you can see the difference. And you might be like, hey, that's awesome. Why wouldn't I want to dividend reinvest? Well, you may or may not want to, depending on if you want to own a big chunk of that one position, that one stock, or not. A lot of times by default, my professional clients have dividend reinvestment turned on by default. And like I said, dividend reinvestment turned on by default creates a bigger position in that stock. One simple tip, stop reinvesting the dividends if your intention is not to have that big chunk of stock. Now, why do I keep talking about this big chunk of stock? Well, guess what? You've accumulated this stock over your lifetime or over your career at that company. But there's going to come a point in time where you're going to want to sell it. Maybe you have to pay for college, pay off your mortgage, go on vacations, fund a retirement. All those things sound great, but there's taxes that you'll owe on the sale of the stock. It's called a capital gains tax. Capital gains taxes can be long-term or short-term, but the bottom line, and for the sake of this presentation, dividend reinvestment creates a bigger stock position. A bigger stock position means we're growing. And at some point I want to sell, and selling that stock has a tax consequence to it. It's just the way the tax code is written. So an easy way to make your taxes a little bit better is to turn off dividend reinvestment. And it's also a great way to diversify a portfolio. That's what we do. We ask our clients to turn off dividend reinvestment if they think they own too much of one stock. And when the dividend pays out, we invest that into another portfolio of stuff that's, diversified, not the exact same position they have, but a diversified portfolio. It's been working great. So it's a fourth tip that I just wanted to leave you with. And by that sound, I think my time's up. So let's just sum it up. At the bottom of this video, there's a green button. You can click that link and, you'll get scheduled on my calendar for a no obligation phone call. And really what that's going to do is help me learn a little bit about your situation and to see if any of the tips that I'm giving you make sense for you. Maybe you're doing a couple of them, maybe you're doing all of them, but it's never a bad idea to talk to an advisor, especially when we get into the esoteric stuff like pairing off losses and gains, or maybe even the bonus tip, which, I talked about the dividend reinvestment. So listen, I'd love to talk to you. It's a no obligation, free 30-minute phone call. We just have a discussion and talk about ways I might be able to help you. If I can't help you, I will be right up front and say, hey, this isn't what I do. We're not a good fit. If I can help you, we can see where that conversation goes. But anyway, I hope you learned a lot in this presentation, and I would really like to hear from you. If you want to talk to me, click the green button, get on my calendar. Let's have a conversation. Thanks so much for watching my presentation. I really appreciate it. Have a wonderful day.